Thanks, Ben, and thanks everybody for volunteering. So I'm going to give a quick bio for Ben so we can let him get started. So we have Ben Garber today, VP of 7 Mile Advisors, is a graduate of Carnegie Mellon University's Tepper School of Business, MBA program, where he served as president of the FlexTime Leadership Council, helping to propel the program to it first in the country per Business Week. He holds a BS in Plant and Soil Science from the University of Vermont, where he also studied community development and applied economics. Ben, I'll let you get started. Thanks for coming.
Allison, thank you so much for having me. It's always such a treat to engage with the Schwartz Center and all of your entrepreneurs. I would add, so I'm originally from Pittsburgh. I've been involved in the investment community here for over a dozen years. I've had some nice exits and some bigger misses. I had a nice exit out of a Carnegie Mellon company called Shoefitter that also received funding from Blue Tree before being acquired by Amazon. And I'm also currently invested in Dynamics, which is a CMU company that was a classmate of mine, and Four Moms, which is one of our more well-known companies here in town. After being on the buy side for about a decade, I recently switched over to the other side of the table and primarily represent sellers. 7 Mile Advisors is a mid-market investment bank, primarily representing founders, family, and management-owned companies in M&A transactions and capital raises. Our transactions range in size from 20 million in total enterprise value up to 400, with our sweet spot really being in the 50 to 250 range. Primarily technology focused, and that stretches it across multiple end markets, business and IT services, consumer, industrial and automation, and I also lead our healthcare practice. We've done 4 deals in Pittsburgh. One was Summit Technologies, which was Ed Engler's company, has a conference room in the Schwartz Center. Sold that to CGI. Touchtown, which is a company I actually diligenced as an angel investment and blew past their forecast. I thought about calling the Venture Capital Association to say Jeff Pepper should get an award for being one of the only angel companies to ever beat forecast. They were acquired by a company called Uniguest. We sold NetSurf 365 to New Spring Capital in Philadelphia. And most recently, sold a cloud services company, Pragmatic Works, to 3Cloud, which is in the South Hills and backed by a private equity firm called Griffin Investors. So coming today from a couple different points of reference, I used to subtitle this talk, Why You Don't Need Lazy Investment Bankers. That's still true, although I'll now add the caveat that we're not all lazy. But with that, absolutely will welcome everyone's participation and really look forward to this discussion. So to kick off here, anyone who has been involved in any capital raising before has most certainly been told, hey, we are very excited about your company. Your company is amazing. It's awesome. You're fantastic. It's just not a fit for us right now. And when you hear that, it's either BS or it could actually be true. And what we're going to talk about today is increasing your chances of finding the right fit at the right time. This is a lot of basic sales prospecting. So anyone who's involved in sales and marketing will understand the funnel that we're stepping through. But these are really, basic sales and marketing skills that are applicable both in prospecting customers as well as capital. So things we'll cover is finding the right fit. We'll touch a little bit on why companies hire investment bankers and what non-technical students can do for startups, which is a question I get all the time. Hey, I'd like to be involved in startups. I'd like to help, but I don't code. So what is it that I can do? So we will cover plenty of opportunities, and there are plenty of companies here at the Sword Center and in the audience that could use that help. So if that's a question you've had, please reach out to me after today's talk, and we'll see if we can match you up with some companies in need of support. If you walk away today with nothing else, this resource right here, Ryan Splenda, your business librarian. This is the most important piece of information you can leave today with. When I was a student, I did not know that we had a business librarian. I frankly did not know what was in the library or where it was or how to find it. I actually relied on an older student who taught me all of these things. And looking back, this information is what I use possibly most out of anything I learned at Tepper. So here's Ryan's email, his contact information. Ryan can follow up with you on any topic that we're covering today and walk you through how to use the databases that we're going to be referencing. In fact, he can even help you do your search to find investors. It's so helpful, it feels like cheating, but it's not. That's just how libraries work. Additionally, Ryan published a paper on a very pertinent topic, positioning the Carnegie Mellon Library as a partner for entrepreneurs and finding funding data. What a pertinent topic. Amazing. Ryan's been a big supporter of this talk for years, and I'm glad to see that he's attracting attention. So I would encourage everyone right now to put his email in your email and shoot him a note to introduce yourself. If you get nothing else out today from today's talk, that's the most important piece of information. So we're going to spend a fair bit of time today going through databases that are available in the library. Many of them are accessible remotely. Some you do have to physically be in the Hunt library. There are some new ones, which are pretty exciting. And I would highlight that investors pay hundreds of thousands of dollars for access to these databases. You have them now, use them. And by the way, you are paying for them. They are in your tuition, so get some good use out of them. The ones that I would like to highlight the most and that we'll touch on today are MarketLine, S&P Cap IQ, CB Insights, and complementing the data that you can get from those resources with Crunchbase, with Dun & Bradstreet, which is merged with Hoover's, with AngelList, with Privco. LexisNexis, which is typically a legal database, has now launched an additional service that we have corporate affiliations. So very similar information as these other resources. And Prekin, fantastic database, went away and has now been added back to the library systems. I would highlight that most of these services are pulling their information from the same sources. So you will generally get, call it 80% overlap. But when you're building out an investor universe, that extra 20% is meaningful. So it's important to cross-reference your searches across multiple databases to make sure you're getting a comprehensive look. Supplementing these with AngelList, Crunchbase, the SEC Edgar portal is a great place to find filings that typically have information that doesn't find it to investor websites or into some of these databases. And a great local resource that you get through the library is the Pittsburgh Business Times and the Book of Lists and all the names that come along with it. So these are all available to you ostensibly for free, so baked into your tuition in the library. So I'd encourage you to use these resources. Before we really get moving, to show a couple examples of the type of information you get, let's look at some recent Pittsburgh deal activity. So InvestEdge was an InnovationWorks portfolio company. They were just acquired in September. They had previously brought on $5 million of convertible debt from Vistria Capital Partners. Partner here is Randy Garg. That's good to know. So if you're thinking about, how do I get bridge funding? If your company is, and we'll get into this, anywhere remotely comparable to the type of business Investage was, Randy might be a good guy to know. And Feather and Gale Capital was the acquirer. I had never heard of them before. Hey, they have their investment criteria right there on their website. So if you're wondering what types of businesses they invest in, they put it right out there. You can also cross-reference this against their portfolio, but they have their size criteria, industries they focus on, company traits, managing partner, and email address. So frankly, what I did in preparing for this presentation is what you all will be doing, which is I shot Liz an email and said, hey, I'm preparing for the Schwartz Center presentation. I saw your recent transaction. We operate in the same space. Let's get acquainted. She emailed me back this morning. Industry Weapon was also acquired in September by a Bertram Capital portfolio company, Spectrio, actually a competitor of Unigast, who we sold Touchdown to. You have their mezz lender, who's also a great intermediary to make introductions. They work across funds. Earlier investors include Ed Engler at Pittsburgh Equity Partners. So if you want to learn more and see who the other angel investors were, and if there's anyone who can help make introductions, if Industry Weapon is generally representative of the type of business your company might represent, sounds like Ed's probably a pretty good place to start. If you can't get an introduction to Ed, intermediaries and service providers network for a living. They're part of the referral economy. Schneider Downs was Industry Weapons accounting firm, and Pepper Hamilton and later Morgan Lewis were their legal advisors. So attorneys and accountants, great resources for introductions. Peptologics is a Carnegie Mellon, General Pittsburgh company, but came out of a lot of familiar names here. So we'll see Pittsburgh Life Science Greenhouse, Idea Foundry, Blue Tree, LifeX. Just raised a $35 million Series B. So when we talk about follow-on capital here in Pittsburgh, plenty of examples here lately that it is there. And hey, another good place to start. So in addition to hey, who's active in Pittsburgh right now? So, often the question is where should I start? A good place is who's active where I am coming in and doing deals like my company would be. Another good place is, hey, who co-invests with Carnegie Mellon today? There's 49 different investment firms that have co-invested or come on after Carnegie Mellon. These are great places to start. Those relationships already exist. They're already comfortable coming in to our ecosystem. So great list of follow-on investors and co-investors that the university can help make those introductions to. So what are we going to cover today? Basic steps here. So number one is identifying comparable companies and their investors. And we'll touch on how comparable is too comparable. What does comparable mean? It really starts with profiling your own company and doing some self-reflection. Then we'll touch on making contact, reaching out, and connecting as part of that first level sales effort, and then what you need to be prepared for these conversations. So first step, pause, take a step back, think about your company through the eyes of an outside investor. Every company is a little bit of a snowflake. Everyone's unique and special, but if you take a step back and you think more in broader categories and generalities, you can certainly bucket your company in appropriate industry categories, as well as target markets. And then it's important to think of company stage. So most investors focus on specific stages of company. So either pre-revenue, pre-earnings, but post-revenue, or it looks like you've really caught some wind in your sails and you're taking off and you're looking for growth capital, or later on, ultimately an exit. Investors are also generally grouped by the size of a check that they write. So if you need $3 million, you can't go to funds that cut checks of $20 million and vice versa. So think about your company in terms of stage and the size of investment that you're looking for, as well as geography. This is less of an issue than it used to be, and it's certainly evolving. Our firm has closed 18, possibly 19, 20 this week deals since the start of COVID. All have been predominantly virtual, possibly one in-person meeting. And if you think about a 6-month M&A process, followed by a 5-year investment horizon as a minimum, one in-person meeting, it's pretty impressive when you think of the type of commitment that both parties are making. So geography used to be an issue. Investors are constrained by geography by mandate. So it's still something to keep in mind. So number one, profile your own company. And I really encourage you to think in broad terms, and that'll allow you to cast a broad net. We'll talk about ranking in terms of quality, but ultimately we got a funnel and you're going to filter as you go in. And in the balance between volume and quality, you have to start with volume because you can't filter for quality if you have nothing to filter.
Ben, are you taking questions throughout?
Throughout, bring them on.
All right, Scott, go ahead, Scott.
Yeah, Ben, thanks for speaking to us. I was curious, when you're looking for investment, how are you thinking about your time horizon with each amount? Like, what's that relationship look like when you're talking to investor and thinking like payback period and how far out you're kind of planning?
Yeah, so it sounds like you brought up 2 items. So one is how much time is it going to take you to raise capital? And then what's the time horizon that the investor is thinking about to get their return? So the first I'd address is time horizon to raise capital. You should be thinking that it will take you at least a year. Some go quicker, but a year is a pretty solid benchmark. When we are running a capital raise process, from the day we're brought on to the day we close is consistently 7 months. However, in a venture scenario, you're going to be doing a lot of pre-work ahead of time. And it's a 2-step process typically where you're looking for a lead investor and then follow-on investors to fill out the syndicate. And that adds some time. So you should easily be starting to prepare to raise capital a year before you need it, likely 18 months. And this is how some founders end up in permanent fundraising, because you also don't want to enter into financing negotiations without any cash. The investors will notice that if you don't close your deal, that you're not going to meet payroll, and if you have any debt, you're going to blow through your covenants, and that puts you at a disadvantaged negotiating position. So you do want to make sure that you've given yourself enough of a time cushion, call it 6 months to a year worth of cash at the point where you're negotiating, and that will be 6 to 12 months after you start your process, probably more like 9 to 12. After that, it will depend on the type of investor that you're taking money from. But generally speaking, investors have a 5 to, I mean, realistically 10, but they don't want to hit 10, especially if, depending on the age of their fund. So you should always generally be thinking 4, 5, 6 years target, knowing that most investments take longer than that to generate a return. Importantly to avoid, and if you see some goofy transactions and you're like, how did that company trade for such a low value? That seems weird. If you peel back the onion, often you can find funds that made an investment towards the tail end of their fund life. And after you've gone over your hold period and you've begun liquidating assets to your limited partners, there are situations where that can force a sale of a company that really doesn't make sense and seems premature. So looking at the fund vintage and how much dry powder, how much cash is left in the fund is very important in making an assessment of whether to take someone's money.
Awesome. Thank you very much.
Absolutely, Scott. And any other questions on that topic? All right. So as I had mentioned, often when people are preparing to say, okay, well, I'm going to start looking for investors. I'm going to start, mapping my part of the investment landscape. How do I get started though? It can sometimes be difficult to get out of the gate. Looking for who's active in Pittsburgh or who's active in your arena. Fantastic. Great place to start. Carnegie Mellon co-investors, great place to start. A lot of these resources also already map out certain industries, and that can be a great place to start to get ideas. CB Insights, I think, does a particularly good job of it, but S&P CapIQ and some of the other services also make these market maps as well. I would additionally call out that you get access to Forrester and Gartner through the library as well. Those are exceptionally expensive research services that focus specifically on industry analysis and sector analysis. And they will call out really key exemplary companies. You can then use those companies as a starting point and see who invested in them at what stages, who were those investors, co-investors. This whole process is like going down a Wikipedia rabbit hole. So just understand it can be a sprint. You can be organized and get it done in 2 weeks, or you can stretch it out over months and keep it as an ongoing activity as you continue to build up your list and build up your buyer database. Some of the market maps that come pre-packaged, already done for you here. Online fashion, InsurTech. We have a pretty active InsurTech practice. And one I didn't even know was we have robotics at the bottom, great for Carnegie Mellon. Did not know that Poop Tech was such a robust industry segment that they now have analyst coverage. This is the type of resource that one of these market maps can provide. So these logos, again, great starting points just to get the ball rolling. So if you're in online fashion, these are the different categories. These are companies who have been funded. If you see any that you think are, again, very broadly comparable, again, same end markets possibly, same sales cycle, same value points, go in, look, see who their investors were, at which stages, and who their co-investors were. Then you can look at the co-investors' portfolios, rinse, wash, and repeat. CB Insights will also let you search for investors by category. So here for fashion, they're listing 805. You can also cross-search, fashion with a particular firm to see how many investments they've made in that sector. And you can sort by how many portfolio companies do they have. So to the question of, well, all right, I'm looking for comparable companies and maybe I can go to those companies' investors, but are investors going to make 2 investments in similar companies? That comes back to, how comparable is comparable and how comparable is too comparable. And it also depends on the size of the fund. So very large funds with massive portfolios. So think dozens of companies. Some will get up to 100 and thereabout. They will invest in similar companies as long as they're not direct head-to-head competitors. So you can be very comparable, similar products going after the same customer base. Their portfolios are broad enough that they would conflict themselves out of a lot of their deal flow if they took too expansive a view of what is a competitor. Smaller funds that maybe have a dozen portfolio companies, and for most firms, 12 to 24 is the ideal number of portfolio companies. That's for a number of mechanical and portfolio allocation reasons, but that's what you'll find, 12 to 24. Those firms will generally take a more broad view. So if you sell sweatshirts for people whose left arm is longer than the right arm, and they have a company that sells shirts serving the same market, probably too close of a fit, but you can take a more broad definition there. Something to call out and to be aware of. So fashion investor here, sometimes you'll come across investors that don't share much information. Generally, I think of that as a red flag. But if you check the SEC filings, so this firm had made an investment in a local company. I was then able to, if they are a director, they will have to disclose who they are on their SEC filings. So I was then able to find Jay Hirsch's name and then go look up Jay Hirsch's SEC filings with Break Trail Ventures. So even though he doesn't put his name on his website, again, red flag, you're able to look him up through his SEC filings and see his fund size. So he was targeting a 20 million raise, TBD, how much of that cash he closed. But that is a handy resource. So even if you don't find people sharing this level of information, you're often able to dig it up, and SEC filings are a great source. An alternative, and this is preferable and best practice, some investors will list everything you possibly need to know right on their website, or go as far as to posting on their LinkedIn page. So if you think about the side of the table that investors are on, they're competing to attract the best deal flow. And if you're a professional and you're in market and you're capitalized, you want to be as transparent as possible about what you're looking for to attract inbound deal flow, which they will call proprietary deal flow, and they will market that to their LPs. Strong debate as to whether proprietary deal flow actually exists, but they all market it. So now I'm going to transition a little bit and talk about the databases that you have available. Again, Ryan Splenda, happy to actually sit down and walk through a search with you and get you moving. You can also save your searches so that you can come back to them. S&P Cap IQ, fantastic from a data perspective. I don't think that they have updated their user interface ever. Certainly not in the dozen years that I've been using it. So just be prepared for that. But they do have this handy feature, find investors. How convenient, amazing. So how does Cap IQ work? It's a query database. They have a number of filters that you're able to apply. So you can pick your industry, you can pick subsectors, you can pick the stage of investment and what type of investments they make. Keywords, I would encourage you to be iterative. These things are not perfect. It will pull in companies that you probably think it shouldn't, and it will exclude companies that you think you would have caught. So one part of looking at comparable companies is just seeing the words they use to describe themselves. And if you find good keywords that are used consistently, that should inform your search. What you will end up with is a list of transactions. And you can see that it filters down pretty quickly. So we're starting, let's see, it looks like with 326,000 investors, and we filtered down to 150. Again, this is iterative. You're going to do it a couple times. You may end up with 5. You'll have to loosen up your search criteria. This is also conveniently the start of a comp table. So after you do these searches, you're going to find comparable transactions. You'll look at the investors. This is an old example, but generally good layout here. So comparable transactions, who are the investors, and then for your company, depending on how much money you want to raise, or are you under 5 million? Are you in the 5 to 10 range? Are you trying to raise over 10? That will help you narrow it down to where you should focus. But all that information is the start of a comp table. So a comparable transactions table is something any investor will be coming to negotiations with, and it will inform the valuations that they will offer. So you owe it to yourself. It's incumbent upon yourself to show up to the table equally prepared. These inherently are not level negotiations. The person on the other side of the table does this for a living. They've done it dozens of times. This is mostly your first time. So coming to the table as prepared as possible for these discussions is really important. And one small thing that you will inherently be building by default as you make your target list is a comp table of other transactions that can inform you as to generally what are multiples that I can reference. Buyers will exclude high multiple transactions and show you a table with low multiple transactions. Sellers will exclude low multiple transactions and include the high multiple transactions that they will bring to the table. When you see investment banks advertising transaction tables, we generally like to show the high ones because it broadcasts, look at all the money that's available for you. Please come hire us and we'll go get it. Buyers, if they are publishing this material, is the other side of the coin. So please keep that in context and know that there is bias in the transactions that are presented. I am now going to give you a tip that, again, will feel 100% like a cheat code. It might be a cheat code, but it's available through the library, so all fair game. MarketLine, fantastic resource, pretty clunky. So it's a great resource to identify transactions, but maybe not dig in too deep on the details. It doesn't allow you to do cross-filtered searches, so you get pretty broad results. But once you do a search, if you click into the detail profile of the transaction and you scroll to the bottom, there is a little window called Ask an Analyst. On the other side of that window is an MBA graduate in a warehouse, I think in Minnesota, probably in the second sub-basement, who is actually doing the same work that we're talking about doing today. To make sure that you're giving that poor soul enough information to bring back good results for you, I encourage you to find 5 really good comparable transactions. You can save the specific transaction ID, and then you can drop into that little comment field, "Dear analyst, I am building a comp table. I would like you to bring me back a comp table with all the necessary information that I'm looking for." And we'll touch on that. And here are 5 comparable transactions to get started. this is my email. Please send me an email confirming that you've received my request. Something a little interesting about this is you hit submit, you get no confirmation number. And typically, unless you put in that last note, several days or a week or two will go by, and then you'll mysteriously get an email saying, here's your comp table. Total cheat code, absolutely amazing. Be aware that it takes about 2 weeks. It is being done by humans in a sub-basement out in the Midwest. But that is another fabulous tip. You're all busy. Maybe you don't have time to be doing all this searching. Get someone else started doing it for you. With all of that said, I'm going to maybe let's look at a specific example here as to the types of information that you're able to get. And let's use a Swartz Center company. So Forest Devices, Swartz company, just raised $1.32 million in December. Elevate Capital was an existing investor. This venture firm and this venture firm were also existing. You see, no one's listed as a lead, but Monozuri Ventures was the lead, and you're able to find that out by digging in. They have 19 investors in total. So these are investors who have invested in early stage Carnegie Mellon, Swartz Center spin out companies. So they are comfortable investing in companies coming from where you're coming from. Down here, you can see some close friends, Ascender, Alpha Lab, here's CMU, got Innovation Works up here, the Dorm Room Fund, and some new names. Monozuri was new to me. Elevate Capital, I had also not interacted with in the past, and they had supported several rounds of funding. So let's take a look at Elevate. So this is your first breadcrumb. You're like, hey, they invested in a company that looks and maybe smells like my company. It came from the same place as my company. Let's go down this rabbit trail. So go to their website. Pretty interesting. Their whole edge is around investing in often overlooked entrepreneur groups. So women, people of color, people with disabilities, or frankly, often companies serving those groups as well. And they tell you which stages of investment that they focus on. Extremely important when you are reaching out to an investment firm. Investment firms hold investment funds. You do not want to reach out at contact@elevatecapital.com. Ultimately, you're trying to reach a person, not a firm. So if you found a transaction, it's comparable, you think this is a good lead for you, you want to find out who led the transaction for the investment firm and reach out to that person, not the firm in general. This information is either listed in one of the databases. Often transactions are announced on the PRN Newswire, and there will be a little announcement, typically goes, investment was made, quote from founder, how excited they are to have a new partner, quote from investor about how great the company is and how excited they are to have been invested. The person who's quoted is typically the person who led the deal, and that's who you want to reach out to. Or, like Elevate, they list who those people are per transaction, so who led the deal for their firm. We can also see, kind of going back into the database, their median valuation round is 6 million. Average round is 750K. 65 total investments, 42 are active. This is an extremely active group, and they do fit in what is often referred to as the funding chasm here in Pittsburgh. So coming on to CMU, we have fantastic resources. The Swartz Center, other CMU funds, Project Olympus, You can go through Alpha Lab and Innovation Works. And I'm not going to say it's easy, but we have a lot of resources to accumulate, call it $500,000 of funding. But what's common is that after that $500,000, companies say, hey, I'm now looking for 2 to 5, or, I'm looking for my next round, and I'm not ready for a 10 million Series A. And unfortunately, it's that gap where a lot of companies can stall out. That was the original reason and continues to be the reason for this talk. So great resource here, active in the area, may be appropriate to fill that gap for you. The lead on the most recent round, Monozuri, new name for me, but you can see that they also provide support services. You can see their early stage investment range up to $1 million. They have Forest devices listed on their website and the portfolio, as well as listing who is the partner who led the transaction. Look the guy up on LinkedIn. Oh man, he's a Tepper alumni. Look at that. How convenient. I bet there's some people in your network who can make an introduction. Fantastic. You can see median valuation, about 8 million. That plays pretty well with Elevate. You can see that they fit similar profiles. And this gets on to an important topic of clubbing. Investors like to invest with investors they've already invested with. They're comfortable with them. They've probably been through some ups and downs together, more importantly, the downs, and know that they can work through it. So looking at investors' co-investors and see if they've repeatedly co-invested with the same people is a good way to quickly get broad access. So you may find an investor who only invests up to $1 million and you think you need 2 or 3. Well, they have a network of other investors that they're comfortable with, that they've worked with, and that they share deals with. So very important to keep in mind. If $1 million doesn't hit your mark, their syndicate of other investors might do the trick. So let's see what they've been investing in. Holy smokes. This group is active. They've already made 2 investments in 2021. Forest was in December. I'm not going to count these, but that looks like at least a dozen last year. So they made a dozen investments through the pandemic. Holy smokes. And equally active in 2019. Deal size. So this is the overall raise. Generally ranging, $500,000 up to, 6, I think seems average. You see an 11, you see a 35, you see a 12, you see a 7. So, really solid, depending on where you are. In Boston, those would be Series C numbers. In Pittsburgh, those are closer to an A. I find a good metric or a heuristic to estimate how big or mature a company is how many people do they have employed. LinkedIn is a great resource to estimate that. Also, if you've seen that a company took a PPP loan, the number of employees will be listed on those loan filings, and those are publicly available as well. For some of these companies, we were also able to get the pre-money valuation. So that's the valuation that the investor offered, said, your company is worth this today. I am then also going to give you cash on top of that. That does not automatically make your company worth more money. You actually have to use that cash to create value. So pre-money value plus cash equals your post-money. Typically, you can get, if you are going to get a multiple, you'll get a revenue multiple. And for growth stage companies, depending on your industry, you're most likely going to be valued on a revenue multiple because typically there's no EBITDA to multiply. That said, another important point of context here, in seed and Series A deals, they're often priced on industry averages with the knowledge that the founder needs to preserve enough equity for themselves and the management team to get through subsequent funding rounds. So when you're going in for, you know, a late seed or an A, and you're raising, call it $3 or $4 million bucks, you know, 6, 7 to 10 million pre-money is pretty normal. And you may be thinking, well, how could my company possibly be worth 7 million bucks? The reality is it probably isn't. But if they value you at 4 and bought half your company, you wouldn't be able to make it through subsequent rounds. You'd end up only owning 5% of your company and you'd be demotivated. They know that. So early stage deals are not necessarily all valued on multiples. There are just general industry ranges that are typical. As I had mentioned, it's important to look at the co-investors. Monozuri has 38 other funds that they have co-invested with. So you would look through their portfolio of transactions, say those companies are broadly similar to the profile that I built for my company, see who else co-invested, and you can start building out your map from there. I'm going to take a quick pause and see if anyone has any questions for what we've covered so far.
I'm curious, Ben, when you're, prospecting, how much of your day is spent doing this research versus, the cold calls and the other pieces to the funnel?
Yeah, so it depends. I personally would prefer that I spend at least 40% of my time selling as opposed to doing like transaction work. If you are prospecting in a sector for the first time, it's going to take you longer to build out your list. If it's a sector that you've operated in for a while and you have contacts and you understand the players, you should still go through this exercise, but you'll already be further along. This does come back to in an earlier point that I just touched on, which is, why do companies hire investment bankers? Number one, it's because you're running a company and you're busy and you don't have the time to do it. So if you should be spending 4 hours a day prospecting, that's 4 hours a day you're not running your business or eating and sleeping, and then your day's gone. So at the base, it's, as the entrepreneur, as the founder or CEO, your most important job is running your company. This is tertiary at best. But like I mentioned, a lot of founders can find themselves in a forever fundraising cycle, only ever raising 18 months worth of cash, at which point you better start fundraising for your next round of cash immediately upon close. So just getting someone else to do it is the biggest benefit. That said, at many investment banks, there are interns or MBA students or first, second, third year out of college analysts doing this work. I have a pretty good idea where I can find some smart students, either in college or in master's programs, who are looking for exposure either to startups or for some reason investment banking, who would love to have some experience that they can put on their resume. So do you need an investment banker? Absolutely not. You can get the same work done by a group of interns. On that note, I bring on interns every year. So if you are interested in an internship, please email me after today's talk. So really, why would you hire an investment banker? It's because they have pre-existing relationships. This isn't going to be the first time that they're reaching out. They should be able to call and have someone pick up the phone because they show that person deals on a consistent basis and they've had a relationship over years. But again, non-technical students looking for a way to help a startup in a meaningful and super important and critical way, this exact work right here, all day, every one of the startups at CMU needs this help. and we have a great body of smart students who are able to provide it. Great question, Meredith. So you've been doing your searching, you've been doing your prospecting, you've been profiling these investors, and now you're thinking about, how to make contact. So absolutely, there's no replacement for a warm introduction. So as you're finding these people, again, search for intermediaries, check your LinkedIn network, see if there's someone who can make an introduction to someone who can make an introduction. There is a hierarchy. So if you are able to get connected to a co-investor, absolute top of the pyramid, these are people who have invested with your target before, and they have that relationship and that trust. Then I would say other investors, just because they operate in the same landscape, come with the same perspective, and generally will be perceived as applying the same filters. Then comes your investors. And on that, I'd like to call out the role of the board. So if your board is not writing checks and not bringing in people who are writing checks, get a new board. Advice is easy to come by. Checks, less so, although it is a very robust market right now. But it is really the role of the board to assist with fundraising. Everything else is protecting their investment. And you can assemble an advisory board who doesn't need all the authority that a real board comes with. So if your board is not using their network to help bring in funding, you really need to think about who's on your board and whether you want to remake that group of people.
Also, Ben, if I've never understood the advisory board to some degree, because if you're starting a company, why are you creating a layer you've got to report to if they're not bringing money to the table? It seems like you've missed the boat.
It's signaling and validation. So if
Yeah,
if it's my first rodeo, I want to at least show that there's adult supervision in the room. That's about it, though. It's really just signaling. Calls. It's the reality of the work. I get a lot of MBA students who reach out to me asking about investment banking. And when I ask them what they think investment bankers do, I usually get these fantastical responses having to do with strategy and finance and modeling. And then I ask them how they feel about cold calling. And after a nice long pause and a quizzical look, I usually get asked, like, what does that have to do with anything? Hey, if you don't already have the network and you can't get a warm introduction, how else are you going to get a hold of someone? Pick up the phone. Emails are good. But another tip here, people under the age of 35 generally are hesitant to cold call and will rely more on email. Emails are easy to ignore. If you catch someone on a call, leave them a voicemail, you have a much better chance of actually connecting. And then two, people will tell you things on the phone that they would never put in an email. So in any of these conversations, you will get a higher degree of information with better depth if you're able to get someone on the phone. And at this particular time, you have the benefit that you are a student. Everyone's happy to talk to students. Once you get out of school, you may be a competitor, or they may want you to pay for their time. But while you're a student, generally, people are going to be happy to take your call and, again, tell you things that they probably shouldn't be telling you because you're a student who doesn't want to help a student.
Ben, you've got another question. Andy's got a question for you.
Hit me, Andy.
Yeah, sure. So Ben, I've heard investors say that they're hesitant to make warm introductions to other investors if they're not already an investor in the company. I think that was maybe a little different than what you had on the slide there. The thought process being that they then have to answer the question of why aren't you investing? So I wonder if you have any thoughts there.
I do. So if you got the answer, hey, great company, it's just not the right fit for us at this time, and that response is true, then they have a valid reason. It might be timing, it might be stage, they might be conflicted, but they have some valid reason, why it's not a right fit at this time. And if they're sincere about that, that should not present any problem with making an introduction. If they are BSing you, it absolutely will be a problem and they won't be able to explain it. So in asking for an introduction, that's a good way for you to test whether you're getting sincere feedback. With that, and impeccable timing, Andy, great question. This is one of the other major tips. If you walk away with no notes, please remember this. Every single conversation you have, ask for 2 introductions. That's how you start building this web. So you're going to get a lot of no's. Just got to get used to it. It builds, Meredith, what do you call it? Grit? Yeah, grit. Builds grit, or what Calvin's dad called character. Builds character. Going to get a lot of no's. It's good for you. But like Andy just asked, get 2 introductions out of every single one of those. And if you do find someone who's interested, get at least 2 introductions. That's how you're going to start building out your network. Other major critical part of this process is organizing all the information that you're collecting. So you can either use a CRM, which that is ultimately the best practice, and there are plenty of free CRMs available. But sometimes that can present an extra step or an extra hurdle, and maybe that prevents you from getting going. So if you're thinking like, hey, I just want to get started, I'm feeling a little overwhelmed, how's an easy way to get started? You can start with a spreadsheet, keep it organized in a way that later it can be uploaded into a CRM. Looks like there's a question. Martina?
Oh, I think she messaged that I think she has to leave, but you're good.
Fantastic.
No questions, just like trying to connect with others, but fantastic talk. Yeah, thank you so much.
Great. Thank you, Martina. So what should you include when you're profiling a potential investor? What types of information are you going to want to keep? So think of these items as potential columns in your sheet. So as you're searching through the databases, as you're doing internet research and you're coming across names and you're digging in, collect all this information in an organized manner. Again, a spreadsheet is fine if you're not using a CRM. You want the investor name, whether it's a firm or a person, a category. Maybe these are angel investors, maybe these are VCs, maybe these are growth funds, maybe they're institutional, like in Innovation Works, or the Ben Franklin Network, or maybe you're going after typical similar types of investors, but some focus on technology, other focus on consumer goods. You may be a consumer technology company. Both will be applicable, but you want to know what general category to put them in. Website description, you can pull from their website, or often LinkedIn has like nicely summarized descriptions. Fund size and fund vintage year were 2 items that we touched on earlier. Sometimes you can try powder or the amount of cash. That's nice to have. Sometimes it can't, and you can estimate it by fund size, vintage year, and number of investments. And again, if you want to get to how much money are they typically spending per company, you would take fund size, divide it by at least 12 to 20. And then it's typical for an investor to hold 2 to 3 times their initial investment for follow-on. So then divide that by at least 2. And that can give you a ballpark, or you can go through that same math, but do 12 and 20 and 2 and 3, and that will give you a range of where their initial investment size will be. Track their investment criteria. Again, that should be posted on their website. Often also in the press releases, there'll be some commentary about why they made the investment. You can snip that. Anytime you're conducting outreach, please go through the step of referencing the investment criteria and saying, do I meet these investment criteria? Then when you do your outreach, say, hey, I meet these investment criteria. And that's one of the specific reasons why I think it's worthwhile for us to get introduced. A reach out with a specific reason as to why you think that introduction is appropriate is multiples more successful than, hey, it's Ben, I'd like to connect. Super, thanks, I'll get back to you. So that comes back to comments and reasoning. You're searching and you're searching and you're going through hundreds of investors. It's super helpful to keep a comments column where you can leave notes for yourself as to why you thought this was a good match at that time. Because you will come back to your list and you'll look at some investors and think, why are they on this list? What was I thinking at the time? It was 2 o'clock on a Sunday. I don't remember. So leave yourself some comments. Help your future self out. It's extremely helpful to also grade the investors in terms of fit. So ultimately, you want as many A's, top best possible fit as possible. And when we go out to market, typically we're reaching out to 100 to 200 investors. A large outreach for us is 300. A small is under 100. So you're really thinking, I want 150 like well-qualified, good fit investors. That's one of the reasons why the searches are iterative. What's going to happen is you'll do your first 2 searches and you'll look at your sheet and you'll have some number of A's. They will not be enough. And then you'll dip down into your B's and you'll start looking at those B's, and some of them you'll think, hey, that could be an A. I was maybe more selective when I put them in a B, but now, that I have a better understanding of the market, that might be an A. So you'll continue to search, you'll fill out your list, but ultimately it's nice to have that hierarchy so that when you're approaching critical mass. So, hey, I might have maxed out my A's, but I have a good set of B's, and I'll go plumbing down into the C's as necessary in order to get that volume that we talked about, and balancing volume and quality. And I personally do find it's still helpful to track the F's, which just means not a fit, because you may come back by the same companies again and think, haven't I already seen this company? And if you kept them in your F bucket, you'll save yourself a little bit of time of not trying to reprofile them. It's also important to track their recent deals. So I actually track 3. I'll do recent deal 1, 2, and 3. And if they're 3 most recent aren't the most applicable, and maybe number 4 is, you can swap those out. But recent deals, the date, the round, the amount, if you can get valuation, and again, importantly, who the lead partner was, because that's the actual human that you're going to be trying to contact. Referencing a transaction is an excellent reason to reach out to someone, and that is one of the specifics that you should put in your reach out. I saw you did this deal for these reasons. That deal is remotely similar to mine, and I meet these investment criteria. I am getting ready for a fundraise, thinking far enough out in the future. I just wanted to get on your radar for these reasons, or we are in the midst of a fundraise at this moment. But referencing a transaction and the criteria are best practices for that initial reach out. And then also for the partners and the firm, be tracking the intermediary connections, because at some point you're going to come back and go, okay, well, now it's finally time for me to reach out to Awesome Investors Inc. What are my different paths to make that connection? And sometimes it takes multiple paths. They may not pick up your cold call or respond to your message, and you can still find a path to get an intro. Another note I'd like to highlight here, this comes back to that timing question. So this prospecting process is ongoing. And as I've been doing and preparing for this, is sending out those introductory messages and setting up meetings as I continue prospecting. That's one method for making these connections, or you do one big push all at the same time. It depends on your comfort level with both. Ultimately, though, when it's time to do the fundraising, you want it all in one big push. You want all the investors on the same time frame, and that drives competition and urgency. You can lay the groundwork for that big push by making these connections in advance, and that way you can save yourself some time and shorten the timetable during your actual capital raise, because this won't be the first time you're having these conversations. People already know who you are. They'll already have that orientation. You will get a higher hit rate on people accepting to have a call with you if there's something actionable. So do not be discouraged if people didn't pick up the phone or respond to you during your, prepping the field stage. They may pick up, when you have something actionable to put in front of them.
And I have a question for you. So usually every mini I get the question about protecting one's IP, and maybe a student is concerned about presenting their business idea in class, even though it feels like a fairly protected space because of concerns over protecting their ideas. I'm wondering, as how you would advise someone with that concern who's doing outreach, to investors who might play in the same sandbox, who might have a similar concern. How would you advise them to think through that risk?
Yeah, so one is almost no, and this is by rule, and I'm fairly comfortable saying no. Investors that you're reaching out to will sign an NDA. Venture investors don't. They get too much deal flow. There's too many angles for them to get conflicted out. So you're not going to have the protection of an NDA. You can ask for it. They're going to say no. Not a great first step. Also, generally, if someone can replicate your company and beat you to market based on what you tell them over a pitch, you might think about how unique your company is and if it's something worth pursuing. If the only thing special about your company is that you had an idea, there's not anything special about the team, your industry insights, your network, if you have technology or product experience. If none of that comes into the picture, it's just that you happen to have an idea. One, I would encourage you to do a search to see if anyone else has ever had that idea. You would not be surprised at the number of companies that come forward like, I had a great idea. And it's like, oh, wow, there are 45 competitors doing the exact same thing. Oh man, I forgot to Google it. But I mean, there should be more that makes you uniquely qualified to turn this idea into a reality that someone's not going to be able to copy just by hearing the idea. And that's the response you're going to get. And if you're concerned about that, then you're going to end up with a very short list of people you're calling on. And there is a conversion rate getting through the funnel. And if you only start with 15 or 20, your chances of getting someone else on the other side are pretty small, and you're handicapping yourself. That said, there are different levels of filtering you can go through so that you are making sure that you're only sharing, as much information as you're comfortable with increasingly qualified parties on the other side of the table. So when you're doing this outreach, let's talk about like what are the materials that you want to have prepared and what's the appropriate level of detail of information to have in those. So we've already gone over building your target investor list. What are all the fields that should be included in that and what you should be tracking, where you find that information and how to conduct that search. We touched on your outreach communication and what that, what you want to cover in that introduction. Again, reference transactions, that you meet their criteria, if you have any mutual connections or mutual discussion points, anything that you can offer up to identify similarities. And then a great document is called a teaser. This is a one-page summary of your company, and you should have full expectation that this one page will travel far and wide. Even if there are NDAs, these things move around. Same with the pitch decks. Nothing you send out will remain confidential. To some degrees, it will, and you can limit the spread, but it's realistic to enter this process with the expectation that these documents are going to move around. The one-page summary of your company should hit on your profile that we started with and compare it to the investment criteria that you've seen across all the investors that you've profiled. So say, this is what we do, this is our product or service, this is the stage we're at, prior funding, these are our operating metrics. So that will be part of people's investment criteria. So you're showing that we match it. You're giving people just enough information so that they can make the decision, do they want to invest an hour of their time in an introductory call? That's the amount of information that you're presenting there, as well as your purpose. We are doing a fundraise. We are looking for a lead investor. We have identified a lead investor, and we're looking for follow-on investors. It is perfectly okay to broadly state the amount of money that you're looking for. And frankly, in early conversations, when you actually get someone engaged, to set some goalposts on valuation expectations. General best practice, and this is what you will hear from attorneys and other investment bankers, is do not negotiate against yourself. So I get asked all the time by both my clients and by investors, what does this company cost? And at that point, I'm guessing because ultimately the market decides the price. And the risk is that you set an artificially low valuation. So if I say 20 million, there is a possibility that the investor on the other side would have come back with a value of 40. But now I've already said 20 and they're like, hot damn, I'm getting a deal. 20 sounds like a good number to me too, I agree. That said, you can end up wasting a lot of time with people who aren't in the same universe. The way we filter this out, it's called an indication of interest, or abbreviated as an IOI. So if you get through your pitch deck with someone, this is pre-letter of intent, this is pre-term sheet. If you don't want to set those goalposts, and again, best practice not to, but it can be easy to filter people out and say, hey, I mean, we are looking at something double digit. We go, oh, I don't do double digits. Don't spend your time here. I wouldn't be that afraid of it. But if you get through a pitch deck and you still have someone engaged, you can ask for an indication of interest, or more plainly, a broad ballpark to make sure that we're at least in the same universe and that we're not going to invest this time and end up in wildly different places. Investors will want to make sure that they are not being insulting to you either, and going through a lot of work and coming back with a very low valuation that wouldn't have been palatable from the get-go. So after a pitch deck is an appropriate time to tease that out a little bit to make sure you're both being respectful of each other's time. The pitch deck, try not to go over 20 slides. Try not to be too wordy. Investors like bullets and graphics and charts. We used to actually write memorandums. I haven't seen a paragraph in years. I don't know what that means, but people's attention spans are getting very short. So keep it, under 20 slides. In addition to expanding on what you had in the teaser, you can expand a little bit, on your plan and what makes you special. And your detailed business plan and early diligence documents, you should have those more or less already organized in your back pocket. What you absolutely want to avoid is, oh my gosh, I got someone on the hook. I've set the hook. They're interested. We're moving forward. And you go, all right, I'm ready to go. Let me see your materials. Oh, I'm sorry. I need another 5 weeks to pull those together. Wrong answer. You've now lost momentum. Speed and momentum are paramount. A successful deal is a smooth deal, is a fast deal. And part of getting that done is being prepared for the conversation going in. For those exact same reasons, have your attorney identified in advance. Make sure they know who you are. They can give you a checklist of documents to start collecting. You don't have to pay them much to get moving, but have them oriented so that when you give them a call and it's time to move, it's not the first conversation you're having. Broadly speaking, you could also say that for an accounting firm, depending on your stage. Early stage, it's less of a component, but you may get into the accounting weeds, and it might be nice to have someone that you can pull in. But absolutely have your attorney already lined up and have these materials prepared so that if someone is interested and they want to move quickly, which is what you want, that you're not the reason things are dragging on. Those are the steps to a successful fundraising campaign. So with that, I would love to open it up and get into any specifics if people are thinking about their own personal situation or experiences that you've had in this process. I will ask if anyone has done any fundraising before. So it looks like it's new territory for a lot of people.
Yeah, I did. I tried fundraising, and it's a process, right? One thing that I learned is that different funding opportunities are looking at companies at different stages. And I think it comes hand in hand with the criteria that you mentioned earlier, but they don't necessarily list it, some of them, but many companies want startups that are not completely new startups. They want you to be far away. Enough far away. And I'm just hypothesizing that it may be related to the fact that about 80% of startups fail. So the success rate is under 20%. So maybe that's why they are waiting.
And when you look at the investments that they've made, you'll get a sense, even if they don't state on their website, we invest in this stage, we want companies with at least this much revenue. By looking through the investments that they've made and when they made them, you can get a good sense of where they're comfortable playing, and also, frankly, what those check sizes are. And those two are typically related.
Yeah, thank you. I also have a question about boards. I hope I won't be derailing the conversation too much, but can you elaborate a little bit on advisory board versus board of directors? How the two differ? What is your advice for somebody like me if I would get the first board role? Or how should companies who are looking for their board members or board directors look for them? And the third question, what is the significance of the board when fundraising?
Yeah, so I'll start with the difference between the advisory board and the corporate board. So the advisory board, like we touched on earlier, is extremely helpful for signaling. So if you're a startup, you don't have a long track record that you can reference. So by having people on your advisory board, you're saying this person has a long track record, they're successful, and they've aligned their name with my name. So you can infer from their participation that I've already been pre-screened and approved by this successful referenceable person. It's important, if you're putting together an advisory board, to do that exact profiling across several categories. Typically, you'll see a technical advisor, and they're there to say, yep, these people are generally not marching completely down the wrong path. There is something to this technology. We will help them, make sure that they're following general best practices. But I am validating by my participation that there's something here, and we're not making it up for the very first time as we go. There is some experience in the room. You'll also want an advisor that has a fabulous network. So this may be a former salesperson, former company exec, someone who's just generally operated in the space, and what they are validating is, yep, this is a match for the end market. This team, has the context and understanding that they'll have a successful sales cycle. And then lastly, there's typically someone who's operated in your industry and has experience growing a company before, and that's showing that there's adult supervision in the room and that there's someone watching over your shoulder to at least head off wrong turns and the deepest of the potholes. That's really the purpose of the advisory board. The amount of advice they actually give varies dramatically, from nearly none to some. But your corporate board ultimately can have authority over the direction of the company, depending on who they represent. So it is typically formed by representatives of your shareholder groups. So if you've gone through multiple rounds of fundraising, there will likely be a representative from each round. Your key investors will seek board seats so that they have that control over the direction of the company. And depending on the amount of equity owned by your shareholders and their rights, and how much you own and your rights and the operating agreement and the shareholders agreement, the board might be able to eject you from your own company. For that reason, often the CEO or founder will have a board seat so they can at least vote in their own favor. But that is something important to keep in mind. Again, ultimately, your board members are just as responsible for bringing money into the company as the CEO. CEO is ultimately the lead fundraiser. But if your board's not bringing in money, you really should think about why they're on the board and how invested they are in the future of the company. The only exception could be an independent board member, which is brought in essentially as an arbiter between the other classes of shareholders.
Looks like Will has the next question.
Yep. Thank you again for this lecture, Ben. This has been very informative, and I've been enjoying it a lot. I was wondering, what is your greatest pet peeve that you see startups consistently do that just kind of drives you nuts?
Oh, man. Well, that's a good question. Legitimately, I would go back to that comment I made about Googling. If I get questions or statements and it's clear that people hadn't done a Google search yet, that is profoundly annoying. Related to that is the statement that we have competition. All the time, there's no competition. We're the only one like us. Every single investor who hears that immediately thinks either you're wrong and you didn't do a Google search yet, which that's a bad signal, or that the market isn't viable and you're pursuing something that can't support a business. I would put those two really at the top of the list. Getting a little bit more into the weeds, I would say, is not paying attention to your cash position. I can't tell you the number of startup board meetings I've sat in where people were debating positioning and hiring and who knows what. And I had to pull the e-brake and remind everyone, hey, by the way, this company runs out of cash in 6 months. So like, why don't we address that first, and then we can, talk about market trends afterwards. And that comes back to someone's earlier question about how far ahead of time should you think about fundraising. 18 months is a pretty good benchmark there. Expecting that it'll take you a year to close, and you want to have a cash cushion going into those negotiations. It is just really frustrating to enter final negotiations. Like, you've gone through all this work, you've engaged all these parties, you've found who you want to move forward with, you've assembled your syndicate, and you hadn't gone through some basic prep early on so that surprises turn up. You're not prepared to respond quickly, so closing drags out. All at the absolute worst time, which is the run up to close. If you want to present tough information, challenges that the company is going through, early in the conversation, and artfully is the time to do that. But, oh man, I have to close now because I'm running out of cash. Oh man, we never actually confirmed that our books are being kept properly. Oh man, we're being sued. I didn't disclose it. Late in the process, surprises are not good for anyone and endlessly frustrating. So I put those in my top three, and that was a fantastic question. I think I'll spend some more time thinking about that before next year. Probably come back with a laundry list.
Thank you very much.
And how often are people coming asking for what you think is the right amount of money for their needs? Sounds like people are undercalling it or under timing it.
I generally think people come in trying to raise not enough money. And there's a couple dynamics here. And the balance is, well, you don't want to sell too much of your company too early. Fundamentally, over time, the value of your company is going up. So you want to sell as little as possible early on, and you want to preserve that. The flip side is you're setting yourself up to potentially fall into that continual fundraising trap, which means for your next round, you likely won't have hit the performance metrics that would necessitate or justify a larger round at a healthy valuation. And that's why you end up seeing companies with like seed 1, seed 2, seed 3, A1, A2, because they haven't hit the metrics yet to actually justify a full-blown B. Because investors will have a sense of, well, we want to see this much traction. There's a couple of key metrics we want you to hit. Revenue should get to a certain point to show traction. We want at least one marquee customer logo, things like that. And if you don't give yourself enough runway to actually do the work to achieve those things, because you wanted to preserve all your equity now, you've ended up handicapping yourself and putting yourself in the situation where 2 years from now, you're going to be raising additional funds because you're out of cash at an equally low valuation or lower, which is called a down round. And now you're losing momentum. It really, really is incredible the importance of momentum and growth rate in attracting investors and maintaining and sustaining valuations, especially in today's market. Depth of technology or product differentiation and growth rate are driving valuation multiples. and you can very quickly see a drop off in valuation multiples when you move from, call it, under 15% annual growth. 25 is a nice place to be. And then if you have a company that's over 35 or you hit 40, now you're officially high growth and you can justify some pretty lofty valuations. The other important thing is that investors cut checks that are a function of their fund size. So if I raise a $100 million fund, I will most likely be cutting checks that are smaller than someone with a $250 million fund. Because one, you need a certain amount of portfolio diversification. That's just best practice in financial asset management. So again, 12 to 24 portfolio companies. And then the balancing factor is that there are just so many partners who only have so much time to spend with so many companies. The number of companies that each individual investor can work with is inherently limited. So you take those two factors and that determines their check size. So if you raise not enough money, too small of a dollar amount, there will be investors who may want to participate, but they will have a minimum check size and they won't be able to participate. And what they'll say is, love your company, but it's not a fit for us right now because you're not raising enough money. And what can be disappointing for everyone involved is if that conclusion is reached too early or prematurely, because there are many scenarios where if the investor said, hey, I would love to invest, but you shouldn't be raising 3 million. You should be raising 9 so that I can give you 3, but I also have a limit that we can only own so much of the round. And I think, in many situations, the entrepreneur would have said, wow, I mean, if I can get good terms, I'd love to raise 9. I just didn't think I could, so I started with a lower dollar amount. This is true for the investment funds as well. I got this feedback myself exploring raising funds and was told, I think I was thinking about raising 50 million bucks. And I heard a couple times, Ben, don't raise 50 million bucks, raise 200 million bucks. You'll have a much easier time. The process is the same to raise small dollars as it is to raise big dollars. And quite frankly, sometimes it's much easier. So generally speaking, I hear people trying to raise amounts that I think are just too small for all of those reasons. And most often, the answer is to double at least, how much money you think you'll need. And you'll still probably end up needing a little more. Andy, I was going to pick on you a little bit and ask if you started to do any of this investor prospecting.
Yeah, I was going to volunteer to comment. So I guess for everybody there, you'll be surprised the people that will respond to you. Just today, I cold messaged a managing director for a Fortune 500 venture arm, and he got back with me in like 15 minutes. So people will respond. And he referred me to his assistant to schedule time. So, I mean, this is a very busy person. The CMU name carries weight. So people will respond.
Go Tartans. Hey, that's great to hear. The CMU name carries weight. I think we all benefit from what goes on in the computer science school. And that's great. Let's take it. I always say it's better to be lucky than good. I'll take both if possible. A pet peeve of mine with investors, so flip to the other side of the table, are ones that attribute all of their success to their smarts and hard work. I've generally found that the most successful people, whether they're investors or not, that I've had the privilege of interacting with, acknowledge the role that luck has had. Most will tell you, you have to work hard to put yourself in the position to be lucky. And that's true. But 50-50 at best. And anyone who doesn't acknowledge that they've, gotten a couple lucky breaks or benefited from a healthy amount of privilege to be in a position to get lucky, and maintains that, I bootstrapped this all on my own shoulders, and that's all there is to it, and anyone else that doesn't have the will or the know-how. I've incredibly irritating and pompous and prevalent.
I would also add, find somebody who will support you and give you time. So for us, that's fortunately been Ben. So really appreciate that. Like we wouldn't have had any success getting, past rounds and competitions without Ben's support. So find somebody who's willing to give you time and in Ben's case, give you critical feedback as well, which I appreciated.
Well, aw shucks, gonna make me blush.
That's probably a good note. Ben, thank you so much for coming and talking, or sitting and talking. This has been phenomenally useful. I thank you for sharing all of your knowledge with this group.
It's a real pleasure. I'll send you and Al a copy of this deck. So all of these resources will be available. My email's up. Happy to have a conversation with anyone. I got an incredible amount out of my time at Tepper and Carnegie Mellon, and I am happy to pay it forward. The school, the entrepreneurial ecosystem has only improved immeasurably in the 10 years since I've been there, and it is just amazing to see what's going on and the caliber and quality of the companies that are coming out of the university.
Cool. All right. Thank you, everyone.